A hawkish Fed forecast catches markets off guard. Welcome to Market Insight. I'm Elena Casas. Wall Street was shaken on Wednesday after Federal Reserve policymakers projected just 2 further rate cuts in 2025, down from 4 as recently as September. Officials now think core PCE inflation will be stuck around 2.5% throughout next year and won't reach the 2% target until 2027. And that means they now see the so-called neutral rate at 3.1%. Well, for more, I'm joined now by Gregory Daco, Chief Economist at EY. Gregory, hello. This is quite a shift in the dot plot since September, isn't it? Why?
Yeah, there was a significant shift in the expectations for future rate cuts. Previously, policymakers were anticipating 100 basis points of easing in 2025. Now they only see 50 basis points of easing next year. That is a significant hawkish move in terms of the direction of travel of the Fed that indicates increasing concerns around the trajectory of inflation, which is likely to be hotter than previously anticipated.
Now, of course, Jerome Powell wasn't keen to comment on policy specifics of the incoming Trump administration, but he admitted some policymakers have taken tariffs, potential tax policy, and immigration into account. So what educated guesses do you think they're making to come to this inflation forecast?
I think that was one of the interesting developments in the press conference. In September, Fed Chair Powell had mentioned that the Fed doesn't guess, doesn't speculate, doesn't assume any specific policy developments. This time around, he indicated that some policymakers may have integrated some policy developments into their forecast. If you look at the median projections, you will see the signs that policymakers did indeed incorporate the likely tariffs, perhaps some deregulation, some immigration restrictions, and some tax cuts into their forecast. I think that's very important to consider because it will affect how the Fed is likely to react to more inflationary pressures if they were to emerge. And that reaction would be to maintain monetary policy tighter than would otherwise be the case in the absence of these inflationary policy measures.
How much more difficult might these policies make the Fed's mandate in 2025?
I think it's going to make it extremely complicated for the Fed, especially in a highly data-dependent environment. Policymakers have been highly dependent on data developments, which means that they're somewhat behind the curve anytime they're reacting to data of prior months. Fed Chair Powell did bring the 2018 Teal Book as a framework of reference as to how policymakers might react to tariffs. Option one back then was to essentially look through the tariffs if inflation expectations were constant. Option two was to essentially react with tighter monetary policy. I think the latest projections indicate that they're more likely to err towards option B, option two, which is essentially to keep rates at a higher level for a more persistent period of time, given the inflationary risks.
You said in your notes that the consensus of strong growth and high inflation early next year seems suspicious. Why is that, and what are you forecasting instead?
Well, I think we have to be careful with the consensus view that there will be strong growth and high inflation. There is the possibility that we see an environment in which growth does slow, where the labor market does slow, and where that constrains consumers' ability to spend. If we have on top of that an inflationary environment, we could very well be in an environment that's very difficult to deal with from a Fed perspective because they would be seeing lower growth and higher inflation. Now, they will likely err on the side of maintaining tight monetary policy, but I would not discount the fact that higher spare capacity in an environment of lower demand could bring down inflationary pressures and lead to more easing than is currently penciled in by the Fed's dot plot for 2 rate cuts. We're maintaining our call of 3 rate cuts. I think the Fed will be more gradual and more cautious in easing, but we're still expecting easing next year.
What makes you suspect, though, Gregory, that these growth forecasts are too optimistic?
Well, I think we have to be very conscious of the fact that some of the policies that will be put in place in the next 4 years are likely to detract from growth. An environment where you have rising trade conflicts around the world, not just between the U.S. and mainland China, but perhaps between the U.S. and other trading partners, and retaliatory measures are going to detract from economic activity and economic growth. So we currently have a forecast that is quite moderate in terms of global growth, around 3.2% for next year, but we have that falling towards 3% in terms of global GDP growth in 2026 because we think that the trade war environment is likely to distract from global economic activity.
Gregory Daco of EY, thank you so much for joining us. Well, that's your market insight. Don't forget to watch more videos on Reuters.com.